Happy morning everyone. After a weak and volatile session yesterday, the big question for today is very simple. Is the market preparing for a relief bounce, or is this just another trap before fresh selling? To understand today's structure, we need to connect global cues, FII behavior, sector pressure, and index levels together, not in isolation. Let's break it down step by step. Yesterday, Nifty closed around 25,860, down nearly 170 points. The index opened weak and remained under pressure for most of the session. Every small recovery attempt was sold into, which shows that buyers lacked confidence at higher levels. Market breadth was clearly negative, with nearly 40 stocks declining, confirming that selling was broad-based, not driven by just one or two stocks. Importantly, Nifty closed near the lower half of the day's range, which keeps the short-term structure weak going into today. Bank Nifty continues to be the biggest concern for the market. Yesterday, Bank Nifty closed around 59,035, losing more than 420 points. The index failed to show any meaningful recovery after the initial fall and remained under pressure throughout the session. Only two banking stocks managed to close in the green, while the rest stayed negative. This clearly tells us that institutional support in banks is still missing. As long as Bank Nifty stays below the 59,300 to 59,400 resistance zone, any upside move in Nifty will remain fragile. Let us begin with the global setup, because it explains why confidence is still missing. Overnight, US markets closed in the red, with the Dow Jones falling by more than 0.5%. The S&P 500 also ended lower, while European markets like FTSE and DIIs remained under pressure. Asian markets this morning are mostly flat to mildly negative, which tells us one clear thing. There is no global trigger for aggressive buying, but at the same time, there is no panic or risk-off shock either. This kind of global environment usually leads to slow, reaction-based markets rather than trending sessions. SGX Nifty is currently trading around 25,930, showing a marginal positive bias. This indicates that the Indian market is likely to open flat to slightly positive, not with a big gap. More importantly, SGX is not giving a directional signal for the day. When SGX behaves like this, the first 30 to 60 minutes become extremely important because the real move usually starts after early traders are trapped. This morning, commodities are showing a clear recovery. Gold and silver are trading higher, while crude oil and Brent crude are up close to 1%. Natural gas is also showing strong gains. This recovery improves global risk sentiment, especially for energy-linked stocks. However, this alone is not strong enough to turn the equity market bullish. The USD INR is trading near 90.93 and is largely stable. A stable rupee removes pressure from foreign flows and helps sectors like IT and capital-intensive businesses. While this is supportive, stability does not automatically translate into buying interest. Now let us come to the most important data point for today, FII activity. On 16th December, FIIs sold approximately 2,382 crores rupees in the cash market. At the same time, DIIs bought around 1,077 crores rupees. This clearly tells us one thing. Domestic institutions are trying to absorb the selling, but FIIs are still distributing aggressively. As long as FIIs continue to sell at this scale, any market bounce will be fragile. Upside moves will face immediate supply. Breakouts will struggle to sustain. This is the main reason why markets are falling slowly instead of crashing, but also failing to rally strongly. India VIX closed near 10.07, falling by almost 1.7%. This sharp drop in volatility tells us that fear is reducing, not increasing. Low VIX environments usually lead to range-bound markets, sudden spikes, and false breakouts. This makes discipline extremely important today. Key levels to watch today. For Nifty, immediate support lies near 25,800, followed by strongest support near 25,700. On the upside, resistance remains at 25,980 to 26,020. For Bank Nifty, immediate support is around 58,900, while a deeper support lies near 58,600. Resistance remains strong at 59,300 to 59,450. As long as indices remain below resistance, caution is advised. Sector-wise focus for today. Banking sector. The banking sector remains weak overall. Private banks are under pressure, PSU banks are not leading. And this means Bank Nifty will remain volatile and range-bound rather than trending. The IT sector continues to face pressure due to weak global tech cues and cautious currency movement. Stocks like Infosys, TCS, and HCL Tech are unlikely to provide upside support today. Energy stocks may show selective stability because crude prices are slightly higher. However, metals remain weak due to global demand concerns, so any bounce should be treated cautiously. FMCG and defensive stocks are helping limit downside but are not strong enough to push the market higher. This confirms that the market is in wait-and-watch mode, not panic mode. What to expect today? FIIs are selling, banks are weak, IT is not supporting and volatility is low. All this together strongly suggests that today's market will remain choppy and range-bound, with sharp moves on both sides but no easy trend. This is a day for patience, discipline and capital protection, not for aggressive trading. That's the complete pre-market setup for today. Trade light, respect levels, and avoid emotional trades. If you found this analysis useful, like the video, share and subscribe to Wealth Maama for daily updates.